Hey everybody, so in this video I wanted to cover Foot Locker's earnings. Now just a heads up, this is going to be an accounting intense video and we're going to go over a deep dive of their financial statements. So right here in their earnings report, it says Foot Locker's total sales decreased 11.4%, earnings per share of 38 cents, and they lowered their 2023 sales and earnings guidance. So just from those three items right there, so far it does not look good for Foot Locker. Now I'm going to go ahead and read you this quote right here. Now this is coming from their CEO. So it says, however, our sales have since softened meaningfully given the tough macroeconomic backdrop, causing us to reduce our guidance for the year as we take more aggressive markdowns to both drive demand and manage inventory. So you guys, this is not good. They're essentially saying, hey, you know what, we're going to mark down our inventory so that we can actually get some demand coming in. So obviously, that's not going to be good for margins. It's not going to be good for profits. And from a cash flow point of view, it's probably not going to be good for cash flow as well. So let's just go ahead and let's scroll down a little bit more. Now, right here, we can see their guidance. So prior guidance, they're saying, okay, well, our sales are going to be down 3.5 to 5.5%. Now they're saying, okay, well, it's going to be down 6.5 to 8%. And then they're saying, okay, well, gross margins are going to be 30.8% to 31%. Now they're saying, hey, you know what, it's going to be 28.6% to 28.8%. And right here on the commentary, they say more aggressive markdowns and higher shrink. Now for non-GAAP earnings per share, keep in mind, this is non-GAAP. They say 3.35 to 3.65, including a 15 cent from the extra week. So now they're saying that, okay, well, we're going to put this down to $2 to $2.25. So this got cut significantly. Now this is a non-GAAP EPS metric. So if we're looking at GAAP, this will be significantly less. Maybe it'll be like $1 or something for the entire year. So obviously, it does not look too good for Foot Locker. Now let's just scroll down a little bit more. And let's just get right to the financial statements right here. So this right here is the condensed consolidated statement of operations. So right here, we can clearly see that, sales came in a little bit less. And then we can see cost of sales, came in a little bit less as well, but that's obvious because, that's in direct relation to sales. They are a merchandiser. So if we go down all the way to the bottom line right here, we can see that diluted earnings per share was 38 cents compared to $1.37 in 2022. So yeah, this literally got shaved like $1. But pay attention to this. Weighted average diluted shares outstanding. This is 95.1 versus 97.2. And I believe that these numbers are in millions. So yeah, this is about 95.1 million versus 97.2 million. So, they actually decreased their shares outstanding. So that's a good thing right there. So that's something you do want to see. Now let's scroll down a little bit more. All right, so if we are looking at how they're doing their adjusted EPS, so this is their reconciliation of GAAP to non-GAAP results. So, what they're mostly reconciling is they're reconciling this line item. It's impairment and other. You can see that right here, they have their diluted earnings per share, which is 38 cents, but then this impairment and other line item is adding back another 36 cents. So what they're saying is, okay, well, our adjusted diluted earnings per share, non-GAAP, is actually 70 cents. So you can see it's almost double. So, if we're just looking at what this note is, so you're going to see that footnote that's right here. So impairment and other, footnote 1. So, okay, what is footnote 1? So it says right here, impairment charges of 18 million, primarily accelerated tenancy charges on right of use assets for the closure of the Sidestep banner, and certain Foot Locker Asia stores. So, I just want to tell you that right of use assets is usually something like lease. So I believe that this is coming from basically early lease termination. So these are just some fees that they have to essentially pay from early termination of their lease, which is causing this impairment in their right of use assets. So that is what I believe this to be. I could be wrong. If I am wrong, let me know in the comment section if you do know a little bit more about this. Now, right here it says impairment and others include $3 million of impairment of long-lived assets and right-of-use assets and accelerated tenancy charges. So more of that stuff. So if we're going down a little bit more, let's see. We're going to look at their consolidated balance sheet. So right here, we can see merchandise inventories right here. So pay attention to this. So in April 30th of 2022, they had about 1.4 billion in merchandise inventory. But here in April 29 of 2023, they have 1.758 billion in merchandise inventory. So what this is telling me is that they are not selling this inventory fast enough. So they're holding on to more inventory, likely because there's not enough demand, which is causing them to mark down their inventory prices, which is why they're giving us this poor guidance for the full year. So, obviously this isn't a good thing. You want to see merchandise inventory, you want to see this number being lower, because that would essentially tell you that, okay, well, demand is there, people are purchasing, and we're turning over our inventory faster. So that's a good thing. But here in this case, this is not a good thing because inventory numbers are higher. So, like I said, inventory numbers are higher. And, we have these other line items. So it says right here, other intangible assets and net. So what is this? And what is minority investments? So a good place to look for this information is that you would actually want to go ahead and jump into their 10K report. So if you jump into their 10K report, I have it pulled up right here. I know that it is on page 54 because I already did a control F and find function. So if we're just looking right here, what are other intangible assets net? Well, let's just zoom in a little bit. So it says right here, other intangible assets net. This is line number 10. Now they say that this is lease acquisition costs, trademark and trade names, customer list, indefinite life intangible assets. So this is trademark and trade names. So these are basically the items that make up the other intangible assets and net. Now, that's basically what this is. Now, what about minority investments? So minority investments, I know that this is going to be on page 52. All right, so let's see. Maybe I got the page number wrong. Let's see. It's around here. All right, so it's actually right here on page 53. So it says, during 2021, we invested $68 million to take a common stock minority stake in a public entity, Retailers Ltd., which is traded on the Tel Aviv Stock Exchange. This investment was at a discount to the initial public offering price. So this essentially means that they were a very early investor because they got it at a discounted price that was lower than the IPO price. So this is kind of telling you what their minority investments are. All right, so let's go back over here. So now we know what these two line items are. So we're going to scroll down a little bit more. And another thing to note is if we're just looking at their total assets, their total assets went down. So that's just one thing to note. And I believe that that's primarily just from their cash and cash equivalent position going down by about over 200 million. So let's just go down a little bit more. And now we see liabilities and shareholders' equity. So we see this account, it's called accrued and other liabilities. So what is accrued and other liabilities? So I know that this is on page 55. All right, so accrued and other liabilities, what are these? So these numbers are in millions. So this is other payroll and payroll related costs, incentive bonuses, taxes other than income tax, property and equipment, customer deposits, rent-related costs, advertising, income tax payable, and other. So of course, we have other within other liabilities. So this is pretty much what makes up this accrued and other liabilities line item. So this is why you want to also have a 10K report pulled up, because they define all of these line items for you. So going back to this most recent report, we could go ahead and look at these line items. And then when we're looking at the total liabilities, do note that total liabilities is actually lower. So this is now 4.4 billion versus 4.66 billion. So when we're looking at total shareholders' equity, this is essentially assets minus liability. So our liabilities went down a good amount. Our assets went down a little bit. So net, when we're looking at total shareholders' equity, this account actually went up. So this is a good thing. You want to see equity go up. And at the same time, you want to see shares outstanding going down. So right here, they have equity going up. They have shares outstanding going down. So that's a good thing. If they had equity going up and they had shares outstanding going up, that's not necessarily a good thing, because if you're diluting your investors, you are essentially increasing your assets because you're receiving more cash. So that's not necessarily going to be positively reflected in shareholders' equity, because when you're doing a certain calculation like book value per share, you're taking shareholders' equity and you're dividing it by shares outstanding. So that is essentially giving you the equity per share. So, obviously if your shares outstanding are higher, that's not necessarily going to be a good thing. So you can clearly see what I mean when you're looking at those numbers. Now, let's scroll down a little bit. And this is the important part, the statement of cash flows. So if I'm looking at cash flows right here, we have the operating activities, and this is showing net income. And from this net income amount, we're basically doing a cash reconciliation. So here you can see merchandise inventories. This is a cash outflow of about $117 million. So when you're looking at something like merchandise inventory, you're not going to see this expense on the income statement that says merchandise inventory expense. That's not how it works. So in the income statement, when you sell something, you also have something called cost of sales or cost of goods sold. And when you sell something, that's essentially when you record the cost of those sales. So when you're purchasing inventory, that's not necessarily reflected in the statement of operations. It's only reflected once you sell that inventory. So just to kind of show you guys, I'm going to scroll back up to the statement of operations. So if we're scrolling back up, this is the condensed consolidated statement of operations. Look right here. It says sales, and it says cost of sales. So we're only recording the cost of the merchandise when we actually make a sale. So if I sell some shoes that were worth $50 and the cost to me was $30, when I sell that shoes for $50, I'm recording a revenue of $50 and I'm recording an expense of $30. That was the cost of sales. So I just want to make that clear to you guys. So let's go back down, and let's go back down to that statement of cash flows. All right, so we're right here. So merchandise inventory. So they're basically just purchasing a bunch of inventory and they're keeping it on hand. And then when they make that sale, that is when they're recording that expense. So as you guys can see, net cash used in operating activities is negative. So that's not a good thing. Now, when you're looking at capital expenditures, that is $59 million. So when you look at free cash flow, that is essentially operating activities. So cash from operating activities minus capital expenditures. So free cash flow here is negative. So that's not a good thing, because you want free cash flow to be positive. That way, you could pay dividends, you could repurchase shares, you could do all these different things. So right here, free cash flow is negative. That's not really good, but you do have to keep in mind that this is just for 1 quarter. And just depending on the year, a merchandiser, they might be purchasing more inventory during 1 quarter versus any other quarter, because they're getting ready for, some sort of upcoming season where, maybe they're selling more shoes. So it's good to look at a 10K report and look at a broader view of the statement of cash flows. So for here, we're going to look at the 10K report and we're going to look at the cash flow section. So I believe this is on page 39. All right, so if we're looking at consolidated statement of cash flows, we want to look at basically this line item right here. So I'm going to go ahead and highlight that real quick. All right, and then we also want to look at this line item right here, the capital expenditures, aka CapEx. So if we're just zooming in on that, maybe I could zoom in a little bit more. Oops, that's too much. So if we're just looking right here, we can see 2022, we have 173 million in operating cash flow, but we have 285 million in CapEx. So cash flow is negative right here. Now what about 2021? We have 666 million in operating cash flow. We have 209 million in CapEx. So free cash flow is positive here. What about 2020? We have 1,062 million in operating cash flow, and we have negative 159 in CapEx. So free cash flow here is positive as well. So what if we wanted to go back even further? Well, I could pull a 10K report of 2020 and also look at this information. So now we're looking at statement of cash flow again, but we're looking at it for a different period of time. So I'm going to go ahead and highlight those same accounts. All right, so now we're going to go ahead and look at this. So 2020 cash flow was positive. Now, if we're looking at 2019, free cash flow is also positive. 2018, free cash flow is also positive. So you could say that, most times Foot Locker has positive cash flow. But, fast forwarding to where we are right now, they're not doing too well because there's not as much demand. So they're not bringing in as much operating income. So therefore, their free cash flow is negative. So this is a down period for Foot Locker. So you have to think that Foot Locker, they primarily sell to consumers like you and me. So, they're basically hoping that people like you and me are doing financially well, and we're just purchasing a lot of different shoes. Some people, they have like 10 pairs of shoes because, they're just splurging or whatever. But, maybe in an economic downturn, we're just going to wear our shoes out. We're not trying to spend $60 on a pair of shoes. So these days, when I go to the mall and I'm looking for shoes, almost all of them are at least $50 or whatever. So to me, it's like, I don't really want to break the bank on some new shoes. I'm just going to wear out these old ones. So obviously, if the economy was doing better, I was making more money, I'll say, hey, let's get some nice shoes, let's show off, do this and that. So obviously, right now, economic downturn, they're not doing too well. They're marking down their prices. That's going to bring down their margins. Then their operating income, that's going to be lower. And then ultimately their free cash flow, that's probably going to be negative. So as of right now, free cash flow is negative. Now, if we're scrolling down, we can see that they're paying dividends also. So, they paid out about $38 million in dividends. So, ultimately they have negative free cash flow. They're paying out dividends. So, their cash position is kind of getting wrecked. So you can see right here, net changes in cash, cash equivalents, and restricted cash. That's $223 million. So they basically started the beginning of the year with $582 million. Now they're at $359 million. So that is a little bit of a cause for concern. So now we're just going to scroll down a little bit more, see if there's anything else. Oh, there actually was one thing that I did want to mention. So if we're scrolling up a little bit more, there is this line item. It's called long-term debt and obligations under finance leases. So we want to look up what that line item is. So I'm going to go ahead and go over to this 10K again. I'm going to look up page 56. Now, if I look at this, you can see right here it says long-term debt and obligations under finance leases. So right here, these numbers are in millions. So how are they financing themselves? Well, they have this 4% senior note that's due in 2029. So this is what this means. 4% means that they are paying 4% on this note. So that is the amount of interest that they're paying. So let's say that, for example, they have a senior note, and let's say that this amount was for $395 million, okay? Well, every single year, they're essentially going to pay 4% in interest of this amount. So that's not necessarily a good thing because, 4% is pretty high. Also, they didn't necessarily take advantage of when the interest rates were low. So that's a problem because if you look at other companies, they were taking advantage of the low interest rates and they were taking out a lot of senior notes. So, other companies, they have like senior notes of like 1%, 1.5%, 2%, because they were essentially taking on a lot of cheap debt when the interest rates were low. But here you can see Foot Locker, they just have this like 4% senior note, and they weren't really taking advantage of the low interest rates for whatever reason. So to me, they're not really financed all that well here. And this note is due in 2029, so you don't necessarily have any sort of worry in the immediate future. Now, if Foot Locker, if they're not doing too well for several years, and then all of a sudden it's 2029, and then this senior note is due, then yeah, that might actually be a problem because they would need to pay the entire maturity of this note. So that's one thing that you always want to be aware of. So to me, overall, Foot Locker does not look like they're all that well financed. So, now we're going to go ahead and we're going to bring up the spreadsheet. So I got the spreadsheet. It's got a lot of different things and it's got a lot of different visuals. So I am pulling quarterly data of their revenue. So if we're just looking at their quarterly revenue, you can see all the way here in 2009, this is increasing, it has its ups and downs, increasing. And then 2020, COVID crash. So basically their revenues crashed. And then, you saw a sharp rebound. But then what's going on now? So if we're looking at their quarterly revenue, we're kind of reverting back to this 2019 area. So you can clearly see that. So as you can see, right now, the revenue trend right now is down. So that's one thing that you do want to pay attention to. And I could just make this a little bit bigger so you guys can see that a little more clear. So yeah, clearly, revenue is going down, so it's on a decline. What about operating income? So operating income, I'm going to make this a little bit bigger. So you guys can clearly see they were losing a ton of money in the COVID crash. And then this sharply rebounded. But then where we are right now is all the way back to the lows of 2017 and 2018. So this is actually lower than that. So we've reverted pretty much back to this area here in 2011. So yeah, quarterly operating income, it's not doing too well. It's sharply declining. And it's actually expected to decline even more because of those markdowns. So that's something that we want to keep an eye on. Now, what about net income? Net income, same deal here. It's declining, and it's probably expected to go down even more because of those markdowns. What about quarterly EPS? So quarterly EPS, it's down quite a bit. So where we are right now is all the way back to these 2017, 2014 levels. So we're pretty much back in this 2012 to 2014 range of earnings per share. So it is not looking good for Foot Locker. Their earnings per share is likely going to fall even more because, like I said, those markdowns. What about price to earnings? So PE, PE is actually shortly going up. And, that's just because, their earnings has gone down, but their stock price hasn't fallen fast enough. So, eventually, this PE number is going to go down a little bit. So, after that recent earnings report, the price that I have recorded right now is $27.35. So that gives us a trailing 12 months earnings per share of $2.49, which gives us a price to earnings of 11. So we already know that earnings are going to fall even significantly more. So, if we were to essentially change this number and, let's just give us a low estimate. So let's say that this is going to be like $1. So if we say that this is $1 instead of $2.49, then hey, guess what? Price to earnings is at 27.35. So that's one thing that you do want to keep in mind is that, future earnings are going to be lower. We don't necessarily know exactly what that number is because they gave us the numbers in adjusted earnings per share. So that's not necessarily reflecting GAAP. So, we could go ahead and put this back to, let's just do Control Z. I think it was $2.49. All right. So what about book value per share? So if we're looking at book value per share, we know that equity is about 3.283 billion. Shares outstanding, that's about 98 million. So if we divide these two numbers, book value per share is $33.47. Current price is $37.35. So we are actually below book value per share. That's important to know. So we're below book value per share. So right now, Foot Locker is severely oversold. Now, if we're looking at the dividend, they're paying us $1.60 every year. So the dividend yield is actually 5.85%. Now, let's go ahead and take a look at the dividend growth. So right here, I have a bunch of numbers going on. So as of now, they're paying 40 cents a quarter. So prior in 2021, they were paying 30 cents a quarter. So this is a 33.33% increase. Now right here, they were paying 20 cents. So from the 15 cents that they were paying around 2020, this is a 33% increase. Now here's the negative news. So here in 2020, they reduced their dividend right here. So this was actually a 62.5% decrease right here. So, obviously dividends got cut right here because they weren't doing too well in 2020. You have to remember that there were a lot of shutdowns. So what about prior to that? In 2019, dividends were 38 cents. And then prior to that, it was 35 cents. So that's a 10.14% growth. So, overall, it would be nice to say, hey, you know what? Dividends are constantly growing. But you can see right here, when they were in a pinch, they cut dividends. So right now, they're kind of in a pinch again. So are they going to cut dividends? So this is a risk right here. So right now, it looks nice and peachy that, the dividend yield is 5.85%. But like I said, their cash flow right now is negative and it's trending in a bad direction. So are they going to be able to sustain this dividend? Because if not, they're going to have to cut it maybe for a few quarters, maybe for like an entire year. And then maybe they're going to have to work their way back up. So you can see right here, when they cut that dividend, they worked their way back up when they were doing well again. So are we going to see another dividend cut? Because that's something that you have to worry about. Because a lot of people, they might just be in this for the dividend. So let's go ahead and let's finally take a look at the technicals. So if I'm taking a look at the technicals, we see this massive gap that occurred. Now, one thing that I do want to note is right now I'm on the daily time frame. So I am on the 10-year 1 day. So if I'm just looking at RSI, we're at 23. So that is severely, severely oversold. If I'm looking at MACD, it is way down here. It's not looking like it wants to cross over anytime soon. If I'm just looking at this trend line, we can see that there's this clear resistance trend line. So resistance right there, right there, right there, right there, right there. We had this false breakout, and then we had this absolute just plummet when we saw that earnings revision, that negative earnings revision, plus, them mentioning all these markdowns, plus the negative free cash flow, and, essentially seeing that adjusted earnings per share getting marked down significantly. So, you can see that where this gap is actually occurs right at this trend line. So we're right back below this trend line, and we're actually right at this fib level right here. So if we're looking at the 78% fib level, this is right around 28. So right now we're actually at 26, 27. So you have to wonder, okay, well, is this going to just continue marching down all the way down to all-time lows right here? Or not necessarily all-time lows, but recent lows right here in the 2020 crash. Is this going all the way back to this 17.46 level? Or is this likely going to rebound and try to retest that 78% fib level right here, right at around 28? So, my bet will be that we're likely going to revisit 28. Just given where the RSI is, it's severely oversold. And, what's going to happen after that? Are we going to stabilize? Are we going to chop around sideways? And what you want to watch out for is, do we get back above this trend line if we stabilize at this 78% fib level? So that is one thing that I am watching out for. So, let's just summarize everything. Let's go back to the spreadsheet. So is Foot Locker necessarily a buy here? Well, that really just depends on what you think the outlook is going to be. We know that free cash flow in the past has been positive. I mean, I showed that to you. In 2020, 2019, 2018, free cash flow was all positive. They were doing well. But right now, they're going through a hard period in time. And as we saw with their financing is not all that great. They're paying pretty much 4% on these 2029 senior notes. If they were to get more financing right now, they would be paying a pretty high interest rate. Because think about it, right now, 2-year notes, I believe they're over 5% right now, or something very near that. So if they were to issue more debt right now, they would be paying ridiculously high interest rates. They don't want to do that. So they probably want to hold out until we start seeing some interest rate cuts. Then they might want to issue some debt. But as of right now, they're kind of in this tight situation where they constantly have these cash outflows. So, maybe they might have to close some locations to essentially build up their cash position. So as of right now, we know that their inventory is not turning as much. We know that they have to mark down their inventory, which essentially means that they're likely going to have very low net profit, or they might even have a net loss. So these are some things that we need to worry about. So in the short term, obviously the economy is not doing all too great if we're looking at these more cyclical stocks. I mean, if you're looking at the tech stocks, they're doing amazing. So tech stocks are doing amazing, but your stores like Foot Locker, they're not doing as well. So, Foot Locker, they might have like 1 or 2 years of a rough time period, but are they going to recover from that? Is right now the time to buy Foot Locker? So my personal opinion is right now is not a bad time to buy. And I showed you guys that they are currently trading below book value per share. So book value per share, that's just equity divided by shares outstanding. And you want to use diluted shares outstanding. So book value per share puts us at $33.47. Now, obviously, if Foot Locker starts losing money, that's not going to be a good thing for the equity, because if they start losing money, equity is going to go down. So let me just talk about equity real quick. So when you have a net income, you essentially take out the dividends. So you take out the dividends from your net income. So minus dividends. And then that equals, I don't want to do that. So let's do minus dividends. So net income minus dividends, that's going to equal retained earnings. And then retained earnings is an equity account. So that gets folded into equity. That is how net income gets folded into the equity account. So it's net income minus dividends equals retained earnings. But if your net income is negative, then yeah, that's going to pull down equity. So that's not necessarily a good thing. So if we're expecting equity to actually go down, then this book value per share number, this might actually go down as well. So that's something that you need to keep in mind. Right now, book value per share is $33.47. In the future, that might go down. Maybe it might be $31. Maybe it goes down to $30. Maybe it goes down to $28. So maybe the stock market is sniffing that out right now, and that's why it's trading below book value. But you have to keep in mind, like I said, the economy is not going to be shitty forever. It's eventually going to rebound. People might want to purchase shoes at a future date. So, there might be future demand, but right now demand is being curbed because the economy is not doing too well. So this is the risk that you're making. You're making the risk that Foot Locker is going to rebound from this shitty situation that they're in. So if you were to buy Foot Locker right now at its weakest point in time, then yeah, this might actually be a good deal. But you always want to keep in mind of the risk situations, which I outlined here. So that is why generally, if I'm purchasing a stock like Foot Locker and it's an individual stock, this is not going to be more than 1% of my portfolio. So, right now I know that I'm getting a good deal because it's below book value. I know that it's severely oversold, and I do know that they do pay me a dividend. So if I did have to bag hold this for a little bit, at least I'm getting a dividend. Maybe in the future they cut that dividend. At least I'm still getting something. But as of right now, the dividend is $1.60 a year, and that is 5.85%. Even if they were to literally slash this, I would still be getting something close to 6% if they just, or 3% if they just slash this in half. So even then, even if they slash the dividend by 50%, I would still be getting some sort of dividend yield. And 3% is even better than investing in SPY or QQQ, because those dividends are pretty crappy. You're essentially expecting share price appreciation. So this is basically my analysis on Foot Locker, and I hope you guys enjoyed this video.